Hey, everybody. Thanks for joining us. I have a fellow cohort from Website Closers, Isaac Porter. Isaac works with me on a number of deals, and we wanted to bring to you a particularly cool session around addbacks. So if you've been in the business of looking at businesses or potentially selling businesses, one of the main pieces that we figure out as a part of the valuation review of your valuation is what sort of expenses don't carry over, don't transition over to the new buyer, because we want to get credit for that. That is a potential value piece in your multiple when we go out and list your business for sale. So Isaac, welcome.
Thanks, Nate. Good to be here. Yeah, it's really interesting topic. I've been speaking with a lot of buyers and sellers. You and I have worked on a bunch of deals together, and the concept of an ad back. What is an ad back? What isn't an ad back? When are we being too aggressive with ad backs, and sometimes when are we not being aggressive enough? Is something that has come up a lot recently. So I thought it would be really helpful to just talk through, conceptually why we use ad backs and why it's very important to think through these non-recurring expenses and how that impacts the valuation of the business and how we go to market with companies that we represent at Website Closers. The first concept I wanted to talk through here was an ad back. In order to be considered an ad back, it's something that was expensed on the P&L that we believe, the seller believes, and that in our case, the broker at Website Closers believes is non-recurring expense, or it was a personal expense of the owner. And so these are things, generally speaking, that go away when the new buyer acquires the company. This is a case of a business that we sold recently, a relatively small company, and it's the case with some of these businesses that the owners have a lot of personal expenses that run through the P&L. And so this is something that almost any small business owner, closely held business, does to reduce their tax liability. It's perfectly legal. It's in fact a great strategy to maximize your earnings while you own the business. But when you sell the business, all those personal expenses don't get transferred to the new owner. So we need to think about what they are and how we give the seller credit for the cash flow that is being generated by the business. So this is a P&L. We'll kind of just start at the top, just so, and we'll put a link to this in your chat, right, Nate?
Yep. We'll make sure that anyone that's listening to this or watching this has access to this afterwards. You can click on the comments of wherever you find the show.
And for the podcast audience, I'm going to just verbally describe everything we're doing here, in case you don't have the visual, and we'll also give a link to the Excel file here. So this company, it's around a $400,000 a year revenue business, and the owners have owned this business for approximately 15 years. They've grown it and managed it really well. And as we went to market this and take it to market, we started to analyze the profit and loss statement and look for some of these personal expenses. And it turns out that there are a number of the owner's personal expenses and other non-recurring expenses that we treated as an add back to the what we call SDE, seller discretionary earnings, essentially the free cash flow of the business. And then we add these add backs to the net income to come up with the SDE, and that's what we use to base our multiple on. So in this case, we've got expenses here, automobile expenses. These are the personal automobiles of the owners. They're able to expense business vehicles, for tax purposes, but certainly those vehicles and the expenses of those vehicles don't get transferred to a new owner. So we treat those as an add back. So we basically add up these line items for the whole year, and we add that to their net income. Charitable contributions is another one that shows up here. It's a relatively small dollar amount. There's $218 in charitable contributions, but that is that's a discretionary expense. A new owner could choose to make charitable contributions, but they're certainly not going to be required to do that. Computer and internet expense is an interesting one. This is their home computers, their Wi-Fi. This one we treat it as an add back because it is their personal expense. This is one that came up in our diligence as the buyer determined that they were going to have the same expense going forward. So this was actually one that the buyer pushed back. And Nate, how often is it when you're on your deals that we've got add backs represented in the transaction, and when you get into due diligence, buyers want to talk about them, validate the add backs, and sometimes push back on the add backs?
I don't usually see it happen too much onesie twosie. Usually it happens on the front end as a part of the overall negotiation of the business. So prior to the LOI, being produced on the buy side, usually they go in and kind of, figure what's going to work for them. And then as they approach the business with an offer, it's kind of here's the offer, and infrequently, quite frankly, to answer your question, we don't do a whole lot of, I have not seen a whole lot of buyers, dig into the addbacks in due diligence. Usually it's done kind of in the negotiation phase up front with the LOI.
Another big one that we see a lot are salary expenses of the owner. And so this one is worth thinking through a little bit. So in this case, the owner's spouse is taking a salary of $19,800. She was involved in the business, but that cash flow is going to be available to the buyer. So that is an add back. And then in addition, whenever you have wages that are getting added back, you need to think through the taxes and the benefits that were also associated with that employee. It's not uncommon for small businesses to have family members on salary that don't actually have a role in the business. Those are absolutely add backs. In some cases, we see where the owner's taking large compensation, where they've got a very profitable business, and they're taking compensation that is in excess of what the average wages for that role would be, that will add back the amount that's over the replacement salary. So if a new buyer comes in and they've got add an employee to do what the previous owner was doing, the difference between that salary and what the old owner was paid could be an add back. So to run through some numbers there, Nate, if you had a business and you're taking a $500,000 a year salary, and the buyer comes in and is going to hire a manager to do the work you've been doing for $100,000 a year, we would treat that as a $400,000 add back, because that extra $400,000 will be available to the new owner.
Yeah, and a comment here, I see this actually happen a lot the other way, especially on larger deals. The owner of the business is not on salary. They're not on payroll. They're just taking distributions, or they're pulling their equity out of the business on the balance sheet. And a buyer will commonly say, well, someone's got to run the business. I'm going to have to either hire somebody, or I'm going to have to pay, a consulting agreement to the founder to stick around. And it's going to cost me at least $150,000 a year. And that is something that does come up regularly on the deals that I've worked on after the LOI, and they'll discuss that as a part of due diligence and what's fair remuneration for somebody who's doing the operational aspects that the founder is doing. And if in fact the founder is truly hands off and is doing, kind of serving more as like a board member or very passive, at that point he already has a team, usually, some executives or upper level managers that's running the business that is included in salary. And in those cases, most buyers can understand that, although it still seems to be fairly rare in that, our marketplace focuses a lot on the $1 million to $150 million size businesses. And even in that range, it's still fairly rare for me to see owners that are truly passive or hands off. They typically have some level of active involvement in the business.
Yeah, it's a great point. And when we have those add backs for staff that needs to be added after the transaction, those are considered to be negative add backs. Those are reductions to the net income, and then we apply the multiple for the particular deal to that number net of that negative add back in that case. That's a great point.
Yeah, you hit some good ones in here up above that though, like retirement, and that's I never have any pushback from buyers when they're the owner has 401k or some kind of retirement planning. That's easy owner benefit.
Yeah. This one. Another category here that was pretty significant for this deal was the shareholder medical insurance. So both of the owners' personal health insurance are running through the business, and so this was in this case $6,500, and it was over $11,000 in the prior year here. So that was a significant add back. That expense goes away after the sale of this business.
Times that by 5, some of the multiples we're seeing on businesses is $30,000. That's a whopper.
Yeah, exactly. And so, our job as brokers is to make sure that we have analyzed the P&L and really found every dollar of value that we can, and that we can substantiate and represent fairly to the buyers that we're working with. So we spend quite a bit of time making sure that we understand the business, making sure that we understand what the ongoing costs are going to be, as well as what non-recurring expenses are that we are able to add back to the profitability of the business.
And that's very unique to us. The other guys out there that are doing mergers and acquisitions often don't spend any time looking at reviewing, finessing the financials, looking for value propositions, looking for add backs. And it's absolutely in the best benefit of the seller to have somebody with knowledgeable guidance from the marketplace of who on the buy side, what add backs they agree to, what they won't agree to. Because if we can find, $100,000, $10,000, $100,000, $200,000 in addbacks, multiply that by the multiple, and that's the extra money that the seller can expect to get at sale.
Yeah, and another big one that I've seen, it's not on this particular deal, but that I see regularly are non-recurring legal expenses for either severance or lawsuits that have been settled. It happens in business that there's a lawsuit that could be a one-off event in a prior year that's part of our analysis for evaluation. If we have reason to believe that that has been settled, the expense has been fully recognized, and that it won't be repeated, then we'll treat that legal expense or severance expense from terminated employees as an add back. Now that will typically bring up another diligence point for a buyer to make sure that there's no liability there post closing that they need to be aware of. But that is one that is a fully legitimate add back, and that we see on a pretty regular basis. You made another point, Nate, that I thought was really good. Around the equity section. So I've had sellers, a number of sellers ask me, hey, I take distributions out of the company. Can those be treated as an add back? And so that gets back to this concept of it's only an add back if it's been expensed on the P&L. So distributions and withdrawals are typically run through the balance sheet. They go through the equity section in the balance sheet. They're not reflected on the P&L. And so because they haven't reduced the net income, we can't add them back. And so, which is fine. It's perfectly good way to take money out of your company through distributions, but it doesn't count as an add back. But it also those distributions have not been removed from the earnings of your business. So you're essentially getting credit for that pre-distribution revenue already.
Yeah, and just beware that when we get into a larger size deal, the buyer is going to push back on that one almost 100% of the time, saying that somebody's doing some work, and there has to be some expense associated with that human capital, that brain power that's going into the business.
Yeah, and in particular, when we deal with institutional investors and buyers, private equity firms, they've got to hire private or professional management to run these companies, and so they do have a real expense that they will layer into the business. I think it's a different conversation when we've got individuals who are buying the business to run it themselves, because then, they will essentially do that job, but they're getting the income directly, and so the add backs sometimes are treated differently based on who the buyer is.
Yep.
Because of the way that the business will be run going forward based on that specific buyer. And then that's a question for the seller when we get those offers in. It's not uncommon for us, Nate, to get multiple offers on a lot of our deals at website closers. And so, part of our job then with the sellers is helping them go through the offers, really understand what the structures are, what the implications are for various buyers, and helping them pick kind of the best offer that's going to net them the best result at the closing.
Absolutely. So we've got some other typical ones in here, like repairs and maintenance. Maybe you could talk a little bit about that one. That's not quite as normal as like cell phones is almost always an add back. We don't have a lot of pushback on that. Personal equipment, computers, and that kind of stuff. I don't usually hear a lot of complaint about that either. And travel for sure. I routinely get travel added back without complaint on the buy side.
Yeah, there's a few here that were, I would say, somewhat non-standard, but that we included in this transaction. So we've got an add back for accounting expenses, and in this case, there was $7,393 for accounting expenses. And what we found out is that actually 80% of that expense was the owner's personal accounting services. So that's their personal tax returns. They have another business, and so all of the accounting was actually running through this P&L. So we verified that those were accounting services not related to the business, and we actually added back just under $6,000, or 80% of the expenses that were not specific to this business, but there were accounting expenses that were part of the ongoing operations of the business, and those are not an add back. Because they'll continue to be expenses going forward, presumably. And similarly here, these owners had multiple businesses. They've got office general administrative expenses, and these were expenses that were shared between the two businesses that run through this P&L. Their other business was more of a startup business, and so we stripped out the expenses from the other business, and we treated half of those expenses as an add back. So that's less common, Nate, that we have some percentage of expenses added back, but it is a possibility and something to think about when there are, a portion of a category that's not related to the business, and it happens. It does happen from time to time that way.
Absolutely. And it's important to remember too that for any of these addbacks to kind of make it through and still be included as your SDE in your final closing, that you have documentation to support where these expenses are, where they came from, and especially if you're doing some, percentages and there's some crossover in the expense with another business, that's going to come up, and you just have to show some sort of proof of it in due diligence.
Yeah, absolutely. It's a great point. A buyer, it's one thing for us to say it's an add back because it was a personal expense, but a buyer is going to want us to verify that and validate it during due diligence. And so as we're putting these deals together, we're making sure that we have the information to support our conclusion that these expenses are going to be non-recurring and not part of the business going forward, and then that becomes information we share with the buyer after the deal is under contract.
Something else to note too, the more complicated this is, the longer it takes for the buyer to verify this in due diligence. So if you're looking for a quick close and you've got a whole checklist of interesting or non-standard add backs, that may be a little bit against the antithesis of what you're trying to accomplish, because they need to verify all that, and it takes time. It's not just looking at a P&L and saying, okay, they want some substantiation, and you have to go find that. That's not something that we as brokers have access to. So on the sell side, you've got to dig into, okay, well, how do I substantiate this? What does that look like? Is bank statement? Is there some receipts? Digging into QuickBooks, Xero, whatever the accounting software is, having all that stuff prepared can make due diligence go much more smoothly. It can also expedite the process, but it just takes time to review.
Yeah, and we also see a number of deals where there are essentially no add backs. We've got just the income from the business, the direct expenses of the business, no owner salary, no personal expenses. Nate, you and I just looked at one either yesterday or today that had virtually no I think actually had no add backs. Very clean P&L, and so we see that frequently too. It's certainly just a choice of how an owner is running their business and their financial statements. We're able to work with really with any style of management through our brokerage process. But to your point, I think it's less for a buyer to do diligence. It is not necessarily a bad thing to have add backs in your transaction, because we do work with them quite frequently.
If I were to go back in time and have a conversation with any potential seller and could give them some advice around how to set up their corporate structure, I would advise them to have a 100% owned pass-through LLC, that in that entity they have all of their personal, travel or automotive expenses, cell phones, put it in there, and then have an additional LLC that is the operating entity of the e-commerce store or the digital marketing agency or whatever it is, and keep that one super clean with no personal expenses on it. Because then you can render a profit and loss and a balance sheet at the operating entity level, free from any nuances of personal expenses, which you can still capitalize on in your holding company and get the tax benefit from that at that level. And it makes things so much cleaner and easier to get through due diligence and sell the underlying operating business entity, whatever it is, it's actually doing the work, without having to go through all of this hassle of the add backs. So you get the best of both worlds. You get all of those expenses from a taxable perspective, and you get the full benefit of the revenue at the operating entity level, which is transitioning over to a buyer.
Yeah, I like that structure a lot. And one of the other things that we will do with our sellers is help them strategize starting up, how to start up and structure their next business after they sell a business. We've had sellers that have had multiple exits with website closers, and so kind of once a seller has been through that process once or twice, I think you start to see those more sophisticated corporate structures in place that are really designed to prepare from the beginning a company to be ready to be sold at a future point in time. And so, we can certainly get involved and offer our strategic guidance at any point in that cycle when we're working with the seller. So a few other, ones here that I think we didn't talk about. There's janitorial services here, which is actually, in this case, was just the cleaning service for the business owner's home. There were office supplies and software, were just miscellaneous expenses that are being run through the business. So this is quite a few addbacks.
Yeah, this is a great example of probably the dirtiest, not like dirty in a bad way, but it's the most, maybe one of the more complicated.
Yeah, it's more complicated. And so on our cash flow analysis, we had to spend some extra time detailing this out, making sure we had supporting documentation to substantiate these expenses were personal in nature, and then helping the buyer really kind of go through the process to validate them all.
Awesome. Any final comments on addbacks, Isaac?
No, I think just the main concept is, if the expense goes away after the transaction or is just non-recurring in nature, it's something that should be included in the valuation of your business. We total up all the cash flow. We look at kind of a market multiple for the particular deal, industry growth rate, and that's how we get to our listing price target. And so it's important as a seller to understand the potential add-back categories that can increase the value of your business. It's important as a buyer to understand why there are add-backs, and if you should accept them, or if those are valid. And it's important for us as brokers to really get deep into the P&L and have really detailed conversations with our sellers, so that we can find the best value for the business as we're taking it to market.
Absolutely. Thank you very much, everyone, for watching. If you found any value an educational value in this video, please hit subscribe below. Also hit the bell so you get notified when new videos come out, and stay tuned, because we've always got more great stuff coming up. Thank you.
Yep. Check us out on Deal Closers Podcast, and great talking with everyone.